The notification popped up on Sarah Chun Soon's phone at exactly 3:47 a.m. on a Tuesday morning in March 2024. She couldn't sleep, scrolling mindlessly through her bank account like she had done countless times before, watching the same $127 sit there, mocking her dreams of financial freedom. But this notification was different. It was from her M1 Finance account, an app she had reluctantly opened 6 months earlier with just $25. Money she had scraped together from returning bottles and skipping her usual coffee runs for a week. The notification showed something that made her sit up in bed, her heart racing. That $25 had grown to $183. Not because she had added more money, not because of some lottery win, but because she had finally figured out what wealthy people had known for decades. You don't need to be rich to start building wealth, you just need to start. Sarah's story isn't unique, and it's not a fairy tale. It is the reality of what happens when you understand that the biggest lie about investing is that you need thousands of dollars to begin. The truth is far more empowering and accessible than the financial industry wants you to believe. Let me take you back to where most people start. That exact moment when you look at your bank account and think there's no possible way to break free from living paycheck to paycheck. You see these finance gurus online talking about diversified portfolios, index funds, and compound interest. But they all seem to assume you have thousands lying around. The reality for most people is completely different. You might have $25 after paying rent, buying groceries, covering your phone bill, and handling the unexpected car repair that always seems to pop up at the worst possible time. That $25 feels insignificant. It feels like throwing a pebble into the ocean and expecting to make waves. But here's what nobody tells you. That pebble creates ripples, and those ripples compound in ways that will fundamentally change your financial future. M1 Finance has become one of the most powerful tools for people starting with almost nothing, because it removes the barriers that traditional investing has always put in place. There are no minimum balance requirements for taxable investment accounts, no trading fees, and most importantly, it allows you to build a diversified portfolio, even with tiny amounts of money through fractional shares. The concept of fractional shares alone is revolutionary for anyone starting with limited capital. Before this technology became mainstream, if you wanted to buy a share of Apple stock trading at $180, you needed $180 plus whatever commission your broker charged. If you only had $25, you were locked out of owning quality companies. You were forced into penny stocks or high-risk investments that promised quick returns but usually delivered quick losses. Fractional shares changed everything. Now, with your $25, you can own a piece of Apple, Microsoft, Amazon, and 50 other companies simultaneously. You're not buying full shares, you're buying percentages of shares, but you own them just the same. And you benefit from their growth just the same. This democratization of investing is less than a decade old, and it's creating millionaires from people who started with less than the cost of a dinner at a mid-range restaurant. When you open M1 Finance with $25, the first thing you need to understand is the pie system. M1 Finance uses this visual representation where your entire portfolio is a pie, and each investment you choose is a slice of that pie. You decide what percentage of your portfolio goes to each investment. This might sound complicated, but it's actually simpler than traditional investing. Instead of trying to figure out how many shares of each stock to buy, you just decide you want 10% in technology, 10% in healthcare, 15% in real estate investment trusts, and so on. M1 Finance does all the math for you. When you deposit your $25, it automatically splits it across all your chosen investments according to the percentages you set. Even better, M1 offers expert pies, pre-built portfolios designed by financial professionals that you can use as is or customize to your preferences. These expert pies cover everything from aggressive growth strategies to conservative income-focused approaches. The psychological barrier of starting with $25 is actually more significant than the financial one. Most people know they should invest, but they procrastinate because they're waiting for the perfect moment when they'll have more money. They tell themselves they'll start investing when they get their tax return, when they get a raise, when they pay off their credit card, when conditions are just right. But here's the truth that successful investors understand. There is never a perfect moment. And waiting costs you far more than starting small. Every week you wait is a week of potential growth you're giving up forever. Time in the market beats timing the market, and the compounding effect of starting early, even with tiny amounts, dramatically outweighs starting later with larger amounts. If you invest $25 today and add just $25 every week for 30 years at an average 10% annual return, setting up your M1 Finance account takes about 15 minutes. You'll need your social security number, your bank account information, and answers to some basic questions about your investment experience and goals. The platform will ask about your risk tolerance, which is essentially asking how comfortable you are with your account value going up and down in the short term. This is crucial to understand before you start. If you invest your $25 today and tomorrow it's worth $23 because the market had a bad day, you need to be okay with that. The stock market is volatile in the short term, but historically trends upward over long periods. If seeing red numbers causes you to panic and sell, you'll lock in losses and destroy your wealth-building potential. The key is to invest money you won't need for at least 5 years, preferably much longer. Your $25 should be money that you can afford to not touch. Money that can ride out the inevitable ups and downs of market cycles. Once your account is set up and you've deposited your initial $25, you face the most important decision: what to invest in. This is where most beginners get paralyzed by options. M1 Finance gives you access to thousands of stocks and ETFs, which are exchange-traded funds that hold baskets of stocks. For someone starting with $25, trying to pick individual winning stocks is not the optimal strategy. You don't have enough money to achieve proper diversification by picking stocks. And frankly, even professional investors with decades of experience struggle to consistently beat the market by picking individual stocks. The smarter approach is to use ETFs, particularly broad market index funds. An S&P 500 index fund, for example, gives you ownership in the 500 largest publicly traded companies in America. With your $25, you're instantly diversified across technology, healthcare, finance, consumer goods, energy, and every other major sector of the economy. You own tiny pieces of Apple, Microsoft, Amazon, Google, Tesla, Johnson & Johnson, Visa, and hundreds of other companies. This diversification protects you from the risk of any single company failing while still giving you exposure to the overall growth of the American economy. A sample portfolio for someone starting with $25 might look like this: 40% in a total U.S. stock market ETF like VTI, which gives you exposure to essentially every publicly traded company in America, from the largest mega caps down to small growth companies. 30% in an S&P 500 index fund like VOO for stable exposure to America's largest and most established companies. 20% in an international stock ETF like VXUS to capture growth from companies around the world and reduce your dependence on the U.S. economy alone. And 10% in a bond ETF like BND to provide some stability and reduce overall portfolio volatility. This portfolio is diversified across thousands of companies, multiple countries, and different asset classes. It's not exciting, it's not going to make you rich overnight, but it's a solid foundation that will steadily grow your wealth over time. As your account grows and you learn more about investing, you can adjust these percentages or add new investments. But this basic framework is more sophisticated than what most investors use even with six-figure portfolios. The automation features of M1 Finance are where the platform truly shines for someone building wealth from $25. After your initial deposit, you can set up automatic weekly or monthly investments of any amount. Even if you can only add $10 per week, automating this process removes the friction and decision fatigue that kills most people's investment plans. Every week, $10 automatically transfers from your bank account to M1 Finance and gets invested according to your pie allocations. You don't have to remember to do it. You don't have to log in and manually make trades. It just happens. This automation also takes emotion out of investing. When the market crashes and everyone is panicking, your automatic investment goes through and buys stocks at discounted prices. When the market is soaring and everyone is euphoric, your automatic investment goes through and buys stocks at higher prices. Over time, this dollar cost averaging smooths out the volatility and ensures you're consistently buying regardless of market conditions. You're training yourself to be a mechanical, emotionless investor, which is exactly what creates long-term wealth. The concept of rebalancing is another powerful feature that M1 Finance handles automatically. As your investments grow at different rates, your portfolio will drift from your target allocations. If you set up your pie to have 40% in US stocks and 20% in international stocks, but US stocks have a great year and international stocks lag, You might end up with 45% in US stocks and 18% in international stocks. Traditional investors would need to manually sell some US stocks and buy international stocks to get back to their target, potentially triggering taxes and definitely spending time managing their portfolio. M1 Finance rebalances automatically with new deposits. When you add money, it directs more of that money to the investments that are below their target allocation, gradually bringing your portfolio back in balance without selling anything. This is dynamic rebalancing that happens seamlessly in the background, while you focus on earning more money and increasing your contributions. The tax implications of investing with $25 might seem irrelevant at first, but understanding them now will save you headaches later. In a taxable brokerage account, which is what most people open first, you'll owe taxes on dividends and capital gains. Dividends are payments that companies make to shareholders, usually quarterly. If you own stocks or ETFs that pay dividends, that money gets deposited into your M1 Finance account, and you'll owe taxes on it even if you reinvest it immediately. Capital gains are profits from selling investments. If you buy an ETF share for $25 and later sell it for $50, that $25 profit is a capital gain. Short-term capital gains from investments held less than a year are taxed as regular income. Long-term capital gains from investments held more than a year get preferential tax treatment with lower rates. This is one reason buy and hold investing is so powerful. You defer taxes for years or decades, allowing your money to compound without being reduced by annual tax bills. And when you eventually do sell, you pay the lower long-term capital gains rates. M1 Finance also offers retirement accounts including traditional IRAs and Roth IRAs, which provide significant tax advantages but come with restrictions on when you can withdraw money. A Roth IRA is particularly powerful for young investors starting with small amounts. You contribute after-tax money, meaning you don't get a tax deduction now. But all the growth and withdrawals in retirement are completely tax-free. If you invest $25 in a Roth IRA today and it grows to $25,000 over 30 years, you can withdraw that entire amount in retirement without paying a penny in taxes. The trade-off is that you generally cut and withdraw the earnings before age 59 and a half without penalties. Though you can always withdraw your contributions without penalties since you already paid taxes on that money. For someone in their 20s or 30s starting with $25, a Roth IRA should be seriously considered because decades of tax-free compounding is extraordinarily valuable. The emotional journey of investing $25 will test your patience and discipline more than any financial concept. The first few weeks are exciting as you watch your money get invested and see your portfolio for the first time. Then reality sets in. Your portfolio goes from $25 to $24. The market had a bad day, or maybe just your investments had a bad day, and you're down 4%. If you added another $25, you're now at $49 instead of $50. You start questioning whether this was a mistake, whether you should have just kept the money in savings, whether investing is just gambling for people who are already rich. This is the critical moment where most people fail. They see red numbers, they panic, and they sell at a loss, confirming their belief that investing doesn't work for regular people. But here's what you need to internalize. These fluctuations are noise. They're irrelevant volatility that has nothing to do with your long-term success. The stock market goes down approximately 1 out of every 3 years, and within those up years, there are countless down days, down weeks, and down months. None of it matters if you're investing for decades. The real magic happens when you stop checking your account obsessively and just let time do its work. There's a famous study of investment accounts that found the best performing accounts belonged to people who had forgotten they had the accounts. They weren't geniuses who picked winning stocks. They were people who invested and then literally forgot about it for years. When they finally remembered and checked, their accounts had grown significantly because they didn't panic and sell during downturns. They didn't try to time the market. They didn't make emotional decisions. They accidentally implemented perfect investment behavior. Buy and hold forever. You don't need to forget about your account, but you do need to adopt this mindset. Check your account monthly if you must. But better yet, set up your automatic investments and then ignore the account except for annual reviews to make sure your allocations still match your goals. As your account grows from $25 to $100 to $500, you'll start to see the tangible impact of compound interest. Compound interest is earning returns not just on your original investment, but on all the growth that investment has generated. It's the snowball effect where your money makes money, and then that money makes money, creating exponential rather than linear growth. With $25, the numbers feel tiny and abstract. A 10% return is only $2.50. But when you have $500 invested, a 10% return is $50. When you have $5,000 invested, a 10% return is $500. At some point, your investments will make more money in a year than you originally invested. That's when you truly understand the power of starting early with whatever you have. The person who starts at 25 with $25 will end up wealthier than the person who starts at 35 with $1,000, assuming they both contribute similar amounts going forward. M1 Finance has a feature called M1 Borrow that becomes available once your account reaches certain thresholds, typically around $2,000 in equity. This allows you to borrow against your portfolio at very competitive interest rates, usually around 3 to 5%. While borrowing to invest is generally risky and not recommended for beginners, understanding this feature is important because it represents one way that wealth builds upon itself. People with assets can access cheap credit, while people without assets pay high interest rates or can't access credit at all. As your M1 Finance account grows, you're building an asset that provides financial flexibility and opportunities. You could use a portfolio loan for emergency expenses instead of a high-interest credit card, or for investment opportunities like starting a business. This isn't about borrowing to spend on consumption. It is about understanding how assets create options that are unavailable when you reliving paycheck to paycheck. The social aspect of building wealth is rarely discussed but critically important. When you start investing with $25, you're going to face skepticism and even mockery from people around you. Friends will laugh at you pretending to be an investor with less money than a tank of gas costs. Family members will tell you to just put it in a savings account or spend it on something practical. Coworkers will share stories about their cousin who lost everything in the stock market. You need to develop a thick skin and stay focused on your goals despite the noise. The reality is that most people who criticize your investing don't have their own financial house in order. They're projecting their insecurities and mistakes onto you. The path to wealth is lonely at the beginning because you doing things differently than the broke majority. But as your account grows and compounds over years, those same people will ask how you did it. And you'll be able to honestly say you just started with $25 and never stopped. Increasing your contributions over time is how you accelerate your wealth building from a slow crawl to a sprint. Starting with $25 proves you can invest and establishes the habit. But to build serious wealth, you need to increase your investment rate as your income grows. Every raise you get, increase your automatic M1 Finance contribution before you increase your spending. If you get a 3% raise, increase your investment by 2% and allow your lifestyle to increase by 1%. This way you're always pushing more money toward your future self, while still enjoying some benefits today. Look for ways to earn extra income specifically for investing. Drive for a rideshare company 1 weekend per month and invest every dollar you earn. Sell items you no longer use and invest the proceeds. Pick up freelance work in your field and invest the income. The goal is to increase your investment rate from $25 to $50 to $100 to $500 per month as quickly as possible, because that acceleration dramatically shortens the timeline to financial independence. The concept of financial independence deserves explanation because it's the real goal behind investing your $25. Financial independence means having enough invested assets that the returns from those assets can cover your living expenses. If you need $30,000 per year to live and you have $750,000 invested generating 4% annually, you're financially independent. You can choose to keep working, but you don't have to work to survive. This seems impossibly far away when you're starting with $25, but every dollar you invest is a tiny piece of freedom. Each invested dollar is a small soldier working on your behalf, generating returns 24 hours a day, 7 days a week, forever. The math is simple but powerful. If you can invest $1,000 per month for 25 years at 10% annual returns, you'll have over $1 million. That's a nest egg that can generate $40,000 per year using a 4% withdrawal rate, potentially covering your expenses without ever touching the principal. You're buying your future freedom $1 at a time, starting with that first $25 in M1 Finance. The mistakes people make with small investment accounts are predictable and avoidable if you're aware of them. The first major mistake is trying to get rich quick by investing in speculative individual stocks, cryptocurrencies, or meme investments that promise massive returns. When you only have $25 or a few $100s, the temptation to gamble on a moonshot is intense. You see stories of people turning small amounts into fortunes with the right bet, and you think that could be you. But for every one person who gets lucky, thousands lose their entire investment. Speculation isn't investing, it's gambling, and the house always wins in gambling. Stick to boring, diversified index funds that will steadily compound your wealth over decades. The second mistake is letting fees erode your returns. M1 Finance has no trading fees, which is why it's ideal for small accounts. But the ETFs you invest in do have expense ratios. These are annual fees expressed as a percentage of your investment. The difference between a 0.05% expense ratio and a 1% expense ratio seems tiny, but over decades it compounds to tens of thousands of dollars lost. Always choose low-cost index funds with expense ratios under 0.20%, preferably under 0.10%. The third mistake is stopping or pausing contributions when life gets hard. Medical emergency, car breaks down, hours get cut at work, and suddenly that $25 per week seems impossible. This is when most people stop investing and never restart. But this is exactly when maintaining your investment habit, even at a reduced amount, is most important. If you can't do $25, do $10. If you can't do $10, do $5. The dollar amount is less important than the habit and the consistency. Every week you skip is a week where you break the automatic behavior that's building your wealth. It is also a week where you miss buying stocks at potentially lower prices if the market is down. Some of the best buying opportunities in history have happened during recessions and market crashes, times when most people are struggling and stopping their investments. The investors who maintained or increased their contributions during the 2008 financial crisis or the 2020 pandemic crash saw incredible returns as the market recovered. Understanding market cycles will help you stay calm and committed during turbulent times. The stock market moves in cycles of growth and decline driven by economics, politics, sentiment, and countless other factors. Bull markets, periods of sustained growth, can last for years, making investors feel like geniuses. Bear markets, declines of 20% or more from recent highs, create fear and panic. Within these cycles are smaller corrections and rallies, creating constant volatility. When you invest your first $25, you have no idea where we are in the current cycle. We might be at the peak of a bull market about to crash, or in the depths of a bear market about to rally, or somewhere in between. It doesn't matter. Over a 30-year investment horizon, you'll experience multiple complete market cycles. You'll see your portfolio double and then cut in half and then double again. The only way to benefit from this is to keep investing through all of it. Buying when prices are high and buying more when prices are low. Trusting that the long-term trajectory is upward as it has been throughout market history. The personal finance community online can be both helpful and harmful when you're starting with $25. Helpful because there are countless free resources, forums, and groups where people share strategies, answer questions, and provide encouragement. Reddit, as personal finance and financial independence communities, have millions of members discussing every aspect of investing and wealth building. YouTube has creators who explain complex concepts in accessible ways. Blogs and podcasts dive deep into investment strategies and interview successful investors about their journeys. All of this information is free and available to anyone willing to learn. The harmful side comes from comparison and unrealistic expectations. You'll see posts from people your age with six-figure investment accounts asking if they're on track. You'll see 25-year-olds who have already achieved financial independence through a combination of extreme saving, high incomes, and lucky timing. You'll see debates about whether you're a failure if you're not investing half your income. This comparison game is toxic and will make you feel inadequate about your $25 start. Remember that personal finance is personal. Everyone's situation is unique. And the only comparison that matters is you today versus you yesterday. The relationship between investing and paying off debt is nuanced and depends heavily on your specific situation. The general rule is that you should pay off high-interest debt before investing, while simultaneously investing even with low-interest debt. High-interest debt means credit cards or any loan with an interest rate above 7 to 8%. If you're paying 18% interest on credit card debt, That's a guaranteed negative return eating away at your wealth. Paying off that debt is mathematically equivalent to earning an 18% return on an investment, which is better than you can reliably expect from the stock market. So if you have credit card debt, you might prioritize paying that off before investing your $25. However, many financial experts recommend investing at least something even while tackling debt, because starting the investing habit and taking advantage of compound time is valuable. You could split your extra money, $15 toward extra debt payment and $10 toward investing. Low-interest debt like mortgages or student loans at 3 to 5% interest is different. The expected long-term return from stock market investing is around 10%. So investing while carrying low-interest debt makes mathematical sense. You're earning a 5% spread between your borrowing cost and your investment return. As your account grows past the initial $25 and you become more comfortable with investing, tax loss harvesting becomes a strategy to understand. Though M1 Finance doesn't automate this as fully as some competitors. Tax loss harvesting means selling investments that have declined in value to realize a loss for tax purposes, then immediately buying a similar but not identical investment to maintain your market exposure. These realized losses can offset capital gains from other investments or up to $3,000 of regular income per year, with additional losses carrying forward to future years. For example, if you invested in an S&P 500 fund that declined from $100 to $80, you could sell it to realize a $20 loss. Then immediately buy a different S&P 500 fund or a total market fund that tracks nearly the same investments. You maintain essentially the same portfolio but now have a $20 tax loss to use. This strategy becomes more valuable as your account grows and your income rises into higher tax brackets. But understanding it early helps you make better decisions about when to sell losing positions. The importance of beneficiary designations on your M1 Finance account is something most young investors overlook but shouldn't. A beneficiary is the person or people who will receive your account if you die. Without a designated beneficiary, your account goes through probate, a legal process that's expensive, time-consuming, and public. With a beneficiary designation, your account transfers directly to your chosen person outside of probate, quickly and privately. This matters even when you're starting with $25 because accounts grow over decades. Your $25 start could be worth tens or hundreds of thousands in 30 years. Taking 2 minutes to designate a beneficiary, whether a spouse, parent, sibling, or trusted friend, ensures that wealth goes where you want without legal hassles. You can and should update beneficiaries as your life circumstances change. Marriage, divorce, children, deaths in the family all warrant reviewing your beneficiary designations. The opportunity cost of not investing is the hidden cost that nobody discusses when they dismiss starting with small amounts. Opportunity cost is what you give up by choosing one option over another. Every week you keep $25 in a regular savings account, earning essentially nothing instead of investing it. You're giving up potential gains. Over 1 year, $25 per week in a savings account at 0.5% interest becomes about $1,300. That same money in investments averaging 10% annual returns becomes about $1,380. An $80 difference. Not life-changing. But over 30 years, that decision between saving and investing makes a $400,000 difference. The money you don't invest is costing you your future wealth. This doesn't mean you shouldn't have any savings. You absolutely need an emergency fund of 3 to 6 months of expenses in a high-yield savings account for true emergencies. But money beyond that emergency fund should be invested and put to work generating compound returns. The cost of waiting and keeping extra cash sitting idle is measured in hundreds of thousands of lost dollars over a lifetime. The final truth about starting with $25 in M1 Finance is that this isn't really about the money at all, at least not at first. $25 won't change your life today, and the returns on $25 won't change your life next month or next year. What changes your life is the identity shift that happens when you start investing. You stop seeing yourself as someone who lives paycheck to paycheck with no financial future. You start seeing yourself as an investor. Someone who owns pieces of the most successful companies in the world, someone who is building wealth. That identity shift changes your behavior in countless small ways. You start thinking about purchases differently, asking whether buying something is worth delaying your financial independence. You start looking for ways to increase your income so you can invest more. You start learning about business and economics because you're literally a part owner of businesses now. You start making decisions with your future self in mind instead of just your present self. This transformation from consumer to investor is worth far more than the dollar amount you started with. Sarah Chun understood this 6 months into her investing journey. When she realized she had stopped buying things impulsively and started automatically asking whether each purchase was worth delaying her goals. The $25 that grew to $183 mattered, but the person she became in the process mattered more. That's the real power of starting with $25 in M1 Finance, not just building wealth, but building the version of yourself who deserves that wealth and knows how to grow it. Your financial future doesn't start when you have thousands of dollars to invest. It starts the moment you decide that whatever you have right now is enough to begin, even if that's only $25.